Imagine this. It's 2020 and there's a guy named Ramesh. Ramesh just started investing in mutual funds. He's excited, dreaming about fancy cars, big houses and a Maldives trip. Then COVID hits and the market crashes. Under panic, Ramesh sells away all his investments, thinking that he's saving himself from losses. And thereafter, till date, he is still waiting for the right time to enter the market. Fast forward to 2025, market has recovered big way, giving massive returns. But poor Ramesh is still waiting for the right time to enter the market. So moral of the story here is, one wrong decision in mutual fund investing and you are left behind while others race ahead. In today's video, I am going to talk about 3 common mistakes which will save you from becoming the next Ramesh. So let's start.
Mistake number 1 is not defining your financial goal. Investing without a clear goal is as good as starting a road trip without knowing your destination. अरे भाई पैसा भी खत्म हो जाएगा, पेट्रोल भी खत्म हो जाएगा, लेकिन पहुंचोगे कहीं नहीं. You will waste time, you will waste money and energy and still stuck at the same place. So let's fix this and learn how to define your goals. Your goals can be categorized into 3 types. Number 1 is your short-term goals.
These are goals you want to achieve in less than 3 years, like a Maldives trip or building an emergency fund. For these, debt funds or liquid funds are your safest bet. Less volatile, no drama, and comes with stability.
Number 2 are your medium-term goals.
These are goals you want to hit in 3 to 7 years. Like buying a car or paying your child's school fees, you'll need balanced or hybrid funds here. It's like mixing vada pav with chai, thoda equity, thoda debt, completely balanced.
Number 3 are your long-term goals.
Now these are the big ones, boss. Goals you aim to achieve in 7+ years. Like planning for your retirement, this is where equity funds shine. You can afford to take risk in long term. Remember, goals are like Google Maps for your investments. They keep you on track and motivated so you don't get lost at some random mall.
Set your destination, pick up the right fund, and enjoy massive returns. Mistake number 2 is timing the market. Timing the market? Arey boss, it is like guessing when your Kamwali Bhai will arrive. It's completely unpredictable. See, the plan sounds very simple. You buy at a low price, you sell at a high price. By the time you figure out the low, the market is already high. Let us take an example of the Axis Blue Chip Fund. Now, this is a fund which invests most of its money into the blue chip companies. Let's talk about this mutual fund during COVID and post-COVID. During COVID-19, imagine the Nifty 50 index, which was trading at 12,500 points, crashed to 7,500 points. It is around 40% dip. At the same time, the NAV of Axis Blue Chip Fund dropped down from rupees 35 to from rupees 34 to rupees 25. But after COVID, the recovery happened. And today, in 2025, the NAV of this same fund has touched around 65 rupees. Now imagine if you have bought units at a price of rupees 25 and today when the price has touched around 65 rupees, you will feel like catching a flight to Dubai and celebrating. Remember, whenever the market falls, your SIP should go on because you get units at a cheaper price. And once the price rises, it's the time to book your profit and celebrate. Mistake number 3 is investing without knowing your risk appetite. You need to know how much amount of risk you can digest, you can take. If you take risk which is above your risk appetite, which is above your capacity, then you will lose your financial goals as well as your mental peace. Now your risk appetite depends upon 4 things. Number 1 is your age.
If you're young, risk lena ekdum common hai. Like eating roadside pani puri without worrying about stomach issues. Young investors can handle more volatility because they have time to recover from losses.
Number 2 is your financial responsibility.
If you're supporting a family or paying EMIs for that 2 BH, you'll prefer safer investments. It's like eating at a trusted restaurant, safe, stable, no stress.
Number 3 is your investment horizon.
A longer time frame lets you take more aggressive risks, like betting on Mumbai Indians in the IPL even if they start slow. long term mean they'll deliver. But short term investors need to stay cautious. Even small losses feel like a pinch when you're on a tight schedule.
Number 4 is your type of personality.
Some people are naturally adventurous, ready to invest in high risk equities, while others are sticking to FD and PPF because risk to risk hai na beta.
Now, based on your risk appetite, here is what works for you. If your risk appetite is low,
which means you're not comfortable with market ups and downs, so go for a debt mutual fund or a fixed income fund or a liquid fund. These are like vada pav, consistent, simple and satisfying. No fancy toppings, just the basics which will deliver returns without any risk.
if your risk appetite is moderate, where you can handle a bit of risk but you want stability, then hybrid funds or balanced funds are the best option for you. It's like having a mixed thali where it's a bit spicy, that's your equity, and it's a bit mild, which is your debt. So bhai, it is very important to understand your risk appetite so that you don't dive into deep waters when you don't know how to swim, and you don't play it safe when you have the capacity to take a risk.